Good afternoon, everybody, and welcome to our webinar this afternoon, M&A Deal Structure Through a Tax Lens. You have two fabulous presenters this afternoon, Mindy Toole and Brad Wilson, and just a few housekeeping items before I turn it over to them to walk you through this presentation in the next hour. You can customize what you're seeing on the screen by using the GoToWebinar screen viewer. You can maximize the presentation or maximize the webcams cams of Mindy and Brad, whatever you prefer there. We do have two audio options this afternoon. You can either use the computer audio, which streams through internet, or you can use the dial-in option. We do see that the dial-in option is a little bit more reliable as it is not streamed over internet. So if you have any issues, try toggling back and forth between the two. For any questions that come in through the presentation, please submit them through the questions panel of the GoToWebinar pane, as we do not monitor the chat box for the next hour. There will be 3 polling questions. Yes, I said it, 3 polling questions, because we are offering that 1 CPE credit for this presentation. We need you to participate in those. We need 85% of the crowd to participate in order to move on to the next slide in the slide deck. And we will have a survey that we need you to complete. Let us know how we did. Any questions that weren't answered throughout the presentation, drop them in there. And that is also where you will select if you need that CPE or not. So if you are looking for that, please make sure that you indicate yes, that you do need that, because that is how we pool our information to send out our CPE certificates. One last mention of the CPE process, please allow about 5 to 7 business days for those to hit your inbox. And if you do not see it, please check your spam and junk folders, as sometimes they like to fall into there. So without further ado, I will pass it off to our presenters.
Hi, everyone. This is Brad Wilson. I'm joined today by Mindy Toole, and as is typically the case, we'll go through some brief introductions, just kind of give you some background on where we come from and our experience, expertise in this area. So Mindy, you care to go first?
Sure. And I'll start with, this is a very good advertisement for keep your profile picture updated. I am Mindy Toole. I started my focus on A&E back in early 2005. And I first dipped my toe into the M&A world with, for anybody who remembers the big Jordan, Jones and Goulding sale to Jacobs. So I kind of just got thrown in head first on that. And over the years, I've been creeping more and more towards the M&A focus. I'm not 100% there yet, but we'll have 3 big announcements in December and for additional closings, and so that's what I'm bringing to the table, the tax piece of an M&A deal.
Great, thanks, Mindy. So it's probably the 4th or 5th webinar I've done this fall, so maybe some of you have met me already, but I'm Brad Wilson. I'm a finance guy, but have spent my entire career working in architecture and engineering community. Never been billable a day in my life in an architecture firm, but done a lot of consulting. Was a CFO and an owner of a firm here in Columbus, Ohio, where I sit. Most like Mindy, didn't really set out to have particular expertise or focus in M&A, but mergers and acquisitions have become a normal thing in the AE industry, part of normal business operations for a lot of firms. And just through the demand of clients who we had done other work for, looking at buying and selling, I got focused into mergers and acquisitions too, a very dynamic, sometimes hectic, but mostly fun part of the work. But if you notice, the nature of this presentation, we're kind of approaching it from opposite ends of the spectrum. I'm a deal guy who has learned enough tax to be able to do my job. And Mindy started in tax and has learned so much about deal structure that we can close the gap between the two of us, that we come at it a little bit differently, but ultimately still have the same goal of not being naive, maximizing our tax benefits, let's call it, inside a merger and acquisition transaction, whether you're a buyer or seller. our plan is to cover both. So I'll flash up here the learning objectives. As I said, buyers and sellers, what you need to be aware of. There's a trade-off, let's call it the rule of diminishing returns and complexity versus benefits, because as you know, tax can be very complex. There's lots of variances or variables in a stock sale or asset sale. We're going to go through several of those. How installment sales, that would be like a promissory note, is treated. How employment agreements and personal goodwill are treated inside deals. Then we'll get into kind of practical applications of things and how to make sure, excuse me, that there's not a late stage failure in a possible transaction because some problem, unforeseen problem or unidentified problem in the seller's accounting, and how you get prepared for all of this before you jump into a transaction. It's too late to start thinking about tax when you're already knee deep in a deal, right? When you're already locked in with one firm, the lawyers are working, you're calculating your return on investment or your after-tax cash, and then you go, oh, wait a minute, we got to pay some taxes in this transaction too. That should have been thought of long ago. And all part of that is our philosophy about having an anticipatory focus. If you've attended other Stambaugh Ness presentations, webinars, you know that we are all about being anticipatory. That yes, accountants generally look in the back and count the numbers that occurred last month, but we on the consulting side try to get out in front of the industry. And in this context of tax, it's not leaving those considerations, untouched until the end of the deal. And if you're considering selling or buying, getting that advice up front, understanding what you have done thus far relative to tax will impact what you can do in the future with your firm. And of course, there's lots of other structures that could facilitate ownership transition or growth, and they all have tax implications. One of those decisions that has been made is going to be our first polling question, because we would like to know, Mindy and I, in talking about this subject, need to know a little bit about the nature of our audience, because different combinations of firms bring about, well, those different combinations of types of firms bring about different tax circumstances. So I'm going to put this up. The polling question is, what corporate tax structure is your firm? And if you would please post one of these four so we can get a quick composite view of who's out there, we can tailor this message a little better towards the particular audience that joined us today.
Alrighty, so the poll has launched. Looks like everybody is with us this afternoon, as about 76% have already voted. Our second option here, LLC or S Corp, taxed as an S Corp, is in the lead with 67%. So I'll give everybody a few more seconds here and then go ahead and close and share the results so everybody can see what their peers are up to. Alrighty.
788, I think we're about there. Good.
Alrighty, so it looks like 67% say that LLC or S Corp option, 8% are saying the partnership or LLP dash LLC option, 3% are saying LLC tax as a C Corp, and 21% are strictly C Corp.
Okay. Well, and that's actually really fortunate, because most entities that Mindy and I have worked with, well, most entities in the AE industry are pass-through entities. The S Corp taxed as an S Corp, as taxes paid at the personal level. And it just so happens we have a lot of experience at that. If you would have said partnerships, we could talk about it. But if you are one of those firms, 8% of you that are partnerships or an LLP, contact us afterwards. We will not focus on that intently today in favor of our S Corp friends, but there will be some differences, and we'd be happy to consult with you afterwards through Q&A or emails afterward to answer the questions that would come up unique to your structure. Okay. One last kind of big picture thing. Okay, what are we truly after as a buyer or seller? How do we stay focused relative to our tax strategy? Really, we believe that it's narrowing down your ultimate goal. Okay, everyone wants to know, well, what's my, on a sell side, what's my firm worth? What's the valuation? How do we do valuations? We did a webinar not long ago about valuing AE firms and the steps and the processes of going through that. Understand that that's only beneficial if you're also managing your tax. The goal for the seller is how much do you have left over at the end, right? And the end is not the closing. The end is filing your tax return after you've closed and figuring out, well, or maybe you've received all your installment payments and all of that. So after tax cash is what we're trying to maximize for our seller clients in an M&A deal. And then from a buyer's point of view, you recognize, of course, that accrual basis numbers are used for valuation purposes, for proper tracking operationally of profit and loss, but your return on investment has got to be measured in cash, right? You paid the seller cash. They won't take your accrual profits. It doesn't do them very much good. You got to actually write the check, and you need money back in order to provide return on investment and show whether or not that acquisition was worth it. Now, wrapped into all of that is this, I don't call it generic, maybe overused term called goodwill. Now, goodwill, the reason why we put it in here is it's got a unique definition, and you might hear, well, it's got multiple definitions. And you might hear Mindy and I kind of jump back and forth with this term goodwill and use it different ways. So we want to make sure we keep the confusion down to a minimum here. There's the first one that I spoke about, valuation. So goodwill in a valuation is the intangible asset value or the money-making potential of the subject firm in the future. It's the expected cash flows based on rearward-looking cash flows and the upside. If a firm is multiplied, excuse me, if a firm's profits are multiplied by a certain number, that number represents, the multiplier of earnings represents the goodwill piece. Then there's also goodwill from the accounting point of view. And that's the amount of value that gets registered on the buyer's books over and above the money that they actually paid out or the assets that they actually were able to book in their as part of the purchase. So, you know, we want deductibility of goodwill from a buyer's point of view. Maximizing goodwill many times to a seller means a higher valuation, but there's still tax implications on goodwill that we have to talk about. And the third, maybe least tax relevant, but almost most important in a deal, is the goodwill between the parties. I know this is on a future slide, we'll say it again. Tax is generally a zero-sum game. That means if the buyer pays it, the seller doesn't have to, and vice versa. And goodwill between the parties means that you recognize that that third party, Uncle Sam, the IRS, however you want to describe it, gets a big chunk of money and really doesn't add any value to the deal. And, you know, the saying about death and taxes was not created by accident. So we need to find a win-win-win. And of course, that third win, let's call it seller win, buyer wins, the government wins, and the government wins by law, right? You can't not do that piece. Really means supporting long-term goodwill relationship-wise between the buyer and seller. Okay, so with that, I'm going to jump over to seller needs and buyer needs. Mindy, if you'd like to jump in here and talk a little bit about the motivations between buyers and sellers, it'd be great.
Absolutely. So kind of the basic rule of thumb is that a seller wants to sell the stock of their firm. It's the easiest in the transaction. The seller realizes capital gains treatment on the gain between the cost and cost basis in their stock. and the sales price. And so this is really the best option for a seller for after-tax cash, right? That's our number one kind of, when you're a seller, again, just like Brad said, how much am I going to get after the IRS gets their firstborn? On the buyer side, however, the buyer, to maximize their ROI, they want to purchase assets. And when assets are purchased in a transaction such as this, then the buyer gets a tax stepped up basis in those assets that were purchased. And then those assets, of course, have a corresponding depreciation tax deduction. And then the balance between all of the purchase price, less the fixed assets and other items that the purchase price is allocated to, that balance is goodwill. Now that is also a tax deduction for the buyer. So goodwill is capitalized for tax purposes and amortized over 15 years. So with the current tax structure and with the current lower long-term capital gains rates, you can see how the M&A market is just being fed. It was already hot, and then now it's really hot in anticipation of capital gains rates that might be going up. So now back to Brad on the firm's valuation.
Yeah, so tax is treated very, let's say there's a high degree of variability in the way that tax is treated inside firms' valuations. Valuation is a starting point. If you're considering selling or buying a firm, you do need to know what the valuation is. But of course, the valuation and the realized value as a buyer or seller, the return that you will get as the buyer or the cash out that you will get, depends a lot on the tax structure and how you have managed taxes prior. We talked about the concept, or I mentioned the concept of personal goodwill. In a lot of cases, well, and here, let me state something obvious. Maybe you guys, if there's a lot of you that have some experience, this is going to be elementary. But those of you who haven't, I just want to make sure you're clear. When there's a stock sale, the seller is the shareholders of the company. When there's an asset sale, the seller is the corporation, right? And the company stays behind. The company is left alone. Okay, the goodwill that Mindy just talked about and the amortization to that can be attributed to the company, or it can be attributed to the individuals who own the company if there are particular rules followed that are, I don't say black and white, there's nothing black and white necessarily in the IRS code, but there are rules that can be followed to make sure that the deductibility of that goodwill is maximized for both buyer and seller. We don't have time to go into what qualifies as personal goodwill or how do you document personal goodwill in a deal. We could probably talk for hours on that alone, but understand that the goodwill can belong to the firm or the goodwill can belong to the individuals, and that there is very different tax treatment, even in the structure of an S corporation versus a C, if you choose to go down the path of personal goodwill. So, the benefits of all of that, documenting personal goodwill, making sure you're not accidentally tripping some wire at the IRS, going to call special attention to yourself and get audited, has to be balanced against the benefits, right? And it says right here, don't be naive about your taxes, but also understand that there's, in many cases, some degree of subjectivity about whether you've gone as far as you should go in trying to make sure that your tax situation is optimized, okay? It can be the most complex portion of the deal depending on what two firms are getting together. And it's just that there's no right or wrong answer. I mean, Mindy, maybe you can speak to this, but I think I've seen you running models after models after models. on an iterative process. What if we do the deal like this? What's the tax look like? Well, let's do it this other way. And not all approaches are available to all entities, correct? I mean, am I accurate there?
You are, and I would say about this keeping the deal simple, just a little anecdotally, we're all seeing a lot of move by private equity into the A&E world. And I caution my sellers as we're evaluating LOIs. So let's say we have 5 and 3 or 4 of them are from private equity. And I just have to be really honest with them and say, listen, dealing with private equity is going to make your deal quite a bit more complex. Now, it's not going to double your professional fees, right? I can't say my fee or your attorney's fee is going to be doubled, but it will be considerably more because the deal is just more complex. And sometimes you're paying for it on the front end through professional fees, but some of those deals with private equity, allow you some possibly tax deferred rollover of your equity that isn't available in what we call just a strategic merger or a strategic acquisition between 2 A&E firms.
Right. Yeah, we've actually got a slide at the end here, if we've got some time, to talk about that complexity because private equity has taken such a more active role in the AE industry. We can go into a little more detail about that complexity. Again, sometimes it pays off, sometimes it's a lot of work for, so here's the thing, at least you may have confirmed for yourself what you shouldn't do. Right, and in many cases that's peace of mind. That's the looking over the edge of the cliff relative to tax law is more comfortable for some than others. We will advise you to not go that far because you've already crossed the law of diminishing returns at that point. So staying focused on your after-tax cash and on your cash ROI means you're going to have to pay some tax in every deal. Okay, there's the active tax management strategies that we see in place in the AE industry when you're not buying or selling have to get reconciled when it comes time to do an M&A deal. So let me explain a little more. I'm going to talk to you just for a minute about 4 areas here, and then we'll go into, Mindy will go into some more detail. But we want to talk about structure effects, the tax structure we just talked about, the S, C Corp, LLC, financial and non-financial concerns relative to assets and stock, tax rate arbitrage going on as far as making sure that you're trying to get in under the deadline, let's call it, with a tax rate increase. And this, if you've done any deals before, you've probably heard about a 338H10 election. That's just a reference to part of the IRS code that applies to an asset sale, or I'm sorry, to a stock sale that can be treated as an asset sale. But before I overstep my expertise here, I'm going to hand it back to Mindy to go into some more detail.
Well, and what I wanted to tell y'all about that prior slide, the tax arbitrage, in case anybody had to Google it, that's your $2 word for the day. That really is just a strategy. It's the technical word for the strategy of, how can I utilize the tax rates and how different pieces of a deal are taxed to my own benefit, right? To my own after-tax cash. Okay, so let's jump in here, and we have tax rate arbitrage on there twice. So I actually want to start at the bottom, since you gave the little teaser on the 338H10, and then we'll dive into it a little bit deeper. At a high level, it is a tax election made by both the purchaser and the seller. And the deal itself legally is a stock deal. However, for income tax purposes, the buyer and seller both agree that it will be taxed as an asset deal. And one of the benefits, a large benefit there is the seller retains, the buyer is able to treat this stock deal as an asset deal, capitalize the assets, depreciate them, capitalize the goodwill, and amortize it. Okay, so now kind of back up to the top of the slide, that election is not available for every buyer, nor is it available for every seller. So that is again to one of our polling question. The majority of A&E firms out there are S corps. And so we just spend a lot of time with S corps buying and selling. And with an S corp buyer and an S corp seller, this election is available. Kind of one of the give backs, which again, of course, I'm jumping ahead a slide. One of the give backs is that the buyer agrees to increase the purchase price for the tax differential. So the seller is 100% made whole. They are in exactly the same spot as long as that tax calculation is correct. As if, you know, they'll pay the same amount of stock or the same amount of tax that they did if they had sold their stock as they will selling their stock taxed as an asset sale. So Brad, do you want to throw in a little of these financial and non-financial concerns?
Yeah, sure. So this is not risk mitigation in M&A webinar. We'll do that someday soon. But understand that one of the challenges with a stock purchase is the buyer gets all known and unknown liabilities associated with the seller, right? I've always used the analogy of a box that you find at a garage sale, and in there's a whole bunch of junk, and the stuff on top you kind of like, and you want to buy that, but it says $50 for the whole box, and the person at the garage sale won't let you just take those nice things off the top. You got to buy the whole box. That's a stock sale. You get everything, whether you want it or not, it's in there, you get it. In an asset purchase, you just get to pick those nice few items you see on the top of that box and take those home and pay something different, perhaps. It doesn't necessarily always mean that case. But one of those things, now talking A&E firm, are client contracts. Obviously, every buyer wants the value of the uncompleted contracts to accrue to them, whether it's assigned because it was an asset purchase, or if it was a stock purchase and those contracts are part of the deal. One way or the other, we got to get those contracts over to the buyer. Now, a lot of clients in the AE industry are getting savvy. They've had lots of their consultants buy and sell each other, and they put in change of control provisions into those contracts. So even if there's a stock purchase, you still have to go talk to them and make sure they're okay with this, sign off on it under your contract terms. It's probably a pretty good idea to go talk to your clients anyway, even if the contract says you don't have to. So again, we're not going to go down that rabbit hole too much further as far as the non-financial legal concerns with stock versus assets, but just understand that this is a multi-dimensional issue. We go, wow, 338H10, that sounds great, best of both worlds. Let's buy stock and treat it like an asset purchase. That's not the end of the story. There's other non-financial concerns that you need to be aware of, need to consider as well. Okay. Mindy, I don't know if we've talked all about this slide at this point. Is there anything on here else that we need to mention about 338?
Actually, it looks like we covered it all. I got ahead of myself. It's just so exciting.
Yeah. Well, and so understand bullet number 3, though, is not automatically a given. Okay, I've been associated with many deals where the buyer is silent relative to a gross up in the purchase price to offset the tax differential. We're going to do a 338H10 because the seller is an S corp and they want to sell stock. Okay, great, we'll agree to that. Then it's up to somebody like Mindy on the seller side to say, hey, wait a minute, Mr. Buyer, if you're getting this tax benefit, we think it's only fair and proper that some of that is shared back with us in the form of the gross up of the purchase price to offset our tax, the tax arbitrage thing that the buyer is working on there. And of course, remember from the very beginning, win, win, win. Seller wins, buyer wins, IRS wins, and then the deal goes through with lots of relationship goodwill. The buyer and seller still like each other, and you don't get the little brown envelope from the IRS. I don't know, do they still send them in brown envelopes? Maybe I'm dating myself. But you don't get an audit notice from the IRS. That all adds up to a better deal.
And I would throw in just a little story of a recent example where a seller was just saying, no, we're not going to do a 338H10 no matter what. And then, we had to advise the buyer that's kind of an unreasonable position. Like they want this big purchase price. This is still a negotiation. And we do all want to make it as tax advantageous for everybody as possible. So seller or buyer just spend just a little bit more. And then of course, seller needs to agree, like they're going to be made whole. So, so then it was an easy, like once you really educate the seller that, a gross up does make you whole, then it's fine. And it does give a lot of relationship goodwill.
So when Mindy and I were putting these slides together, we had to draw a line about how tax geeky we were going to get, how far in the weeds. But there is one variation on the 338 that I'm going to let her talk about with the 336E election. And this table maybe says it all, but just to understand, this is one kind of step deep into the code that we don't really have time to go this deep in all aspects. But this does impact S corps and C corps differently.
It does. So in general, a regular old C corporation is not eligible for a 338H10 election. It really is, even though we've got this member of a consolidated group and an extra or in my description there, it really is designed for an S corp. And an S corp with only a single corporation purchaser, right? So it's private equity can still be involved in a deal like this, but not, of course, not they're purchasing a C. So you see there are some down in the weeds, right? You have to purchase at least 80% of the seller's stock. Neither purchaser nor seller may be foreign, which these days in the M&A world, right, there is a lot of interest, international interest in American A&E firms. And what I'm seeing is just US-based domestic holding companies being set up to where a foreign investor or a foreign firm can still come in as a purchaser. Again, we covered this is a joint election, and as shareholders of an S corporation, all shareholders have to agree to this treatment. Okay, so now what do you do if you're not an S corp though, or if you're not, the small little group of members of a consolidated group? Well, domestic C corps and a QSD means a qualified stock disposition. So it's not just the entity, but the transaction is structured in such a way that there is this qualified stock disposition. So the domestic C corp, or there is an instance where an S corp can use it. It's not common, right? S corp usually uses 338H10. But all of the members of a consolidated group who dispose of their stock, they are considered a single seller. So this is where we kind of have some more room. The purchaser can be an individual or a partnership or multiple purchases. Well, in the A&E world, we don't see very many partnerships, taxed as a partnership. Some of that is partly, I think, just because people think it's complicated, which it kind of is. Subchapter K of the code is the most complicated section of the code. But if, let's say you're a transportation firm and you do a lot of overhead or work, subject to an audited overhead rate, it's just too much of a hassle to deal with labor rates for a partner in a partnership not receiving a W-2 and instead receiving guaranteed payments on a K-1, right? So that's why we don't normally see partnership sellers. Now, we may see an LLC purchaser. But again, this other election, 336E, which is the same thing, treats a stock deal as an asset deal for tax purposes, is available to that LLC or partnership purchaser. So you can have multiple transactions or multiple deals in the same transaction, as long as everything is still equal to 80% of the seller's stock. Again, neither purchaser nor seller may be foreign. Again, joint election, and everyone on both sides has to agree to this treatment. I actually don't even know why anyone on the purchaser side wouldn't agree to the election, but I also haven't dug into court cases to see who would be arguing that they didn't like it.
Didn't like it.
But okay, so was that in the weeds enough? We may have another page in the weeds.
Deep in the weeds, I'm still awake. I don't know, we still got 80 people on here, so I think they're awake too. But so we've talked here about how corporate structure can impact the choices that you have to manage your tax. Let's talk for a minute now about deal structure considerations. And Mindy and I might pass these back and forth a little bit. We've got a lot of stories related to this. Almost every deal that we've done will have some payments over time. Those payments over time treated as an installment sale, a note, a promissory note. It's taxed in the year in which the cash is received, not in the year that the transaction was closed, unless you want to do something to accelerate that because you're concerned about future tax rates. And of course, there's a complexity factor that ramps up the complexity. Is that okay for the buyer? Is that proper tax treatment for the seller? If there's no note or installment sales, then you don't have to worry about it, obviously. But it's another thing that can have a major impact on the way the taxes are looked at. Some firms have done stock swaps. Those can be taxable and tax deferred. The percentage of the stock being swapped as a total percentage of the value of the deal matters. The tax structure of the two firms matter. Mindy, any other big considerations? I know you've done something like this recently. Anything that I'm missing as far as limitations on swaps?
Well, I think there's some nomenclature that might help people. There is no tax-free rollover, right? IRS gets their piece.
It's tax-free anything, right?
And usually a tax-deferred rollover is a deal structure in which there has been probably an F reorg. So that's a little bit in the weeds. That's a section 368A1F reorganization. We all call it just an F reorg. But that's probably the most, sorry, I got a little nerdy there.
There goes the geek again, yep, I got it.
Probably where I see the tax deferred rollovers the most. Not in a normal strategic, one firm buys another firm kind of deal. Most of the times that piece of the deal is taxable.
Great, okay. One of the other things is you can sell your assets and receive stock of the buyer. Now, one of the challenges with that, as you can see, it's treated as taxable just as if you got cash and then you bought the stock. Either way, that's called a non-cash taxable event. You receive stock for your assets, you owe tax on that stock, and you didn't get any money in the process. You as a seller may have to come out of pocket for the tax on the value of the stock that was received. So that has to be done sensitively. And again, win-win-win between the three parties has got to be the focus. Make sure that everyone is clear about the taxability of that transaction. The other one that's very prevalent is called an earnout. And in an earlier M&A webinar, we talked about the pros and cons about earnouts, about, it's not guaranteed. It's based on future performance as measured by the buyer in some way. It's taxable in the year in which it was received. Most of the time, right, Mindy, it's taxable as regular income. It's tough to get capital gains treatment on an earnout, not impossible, but the structure of that earnout is very crucial in the way in which it gets taxed. Correct there?
Which there is a way to structure it in your purchase agreement to where it receives installment sale treatment. It's just you recalculate your purchase, it is technically a purchase price adjustment in year whatever, 2, 3, and 4. So you recalculate your gross profit percentage.
Sure.
You recalculate your gross profit percentage in those subsequent years. The little catch about that is you don't get to take that recalculated gross profit percentage back to your first year, right? So it is a beneficial change. It's just only a beneficial change going forward.
Right. And of course, the buyer would like the immediate deductibility of a bonus payment as opposed to additional purchase price that has to be amortized over time. So of course, the earnout structure is always a negotiated thing, just like the next bullet, non-compete, non-solicitation agreements. Value can be assigned to non-compete, non-solicitation in an asset purchase. Every part of every purchase agreement, because of the legal community undermining the non-compete restrictions, almost every purchase agreement has got some non-compete, non-solicitation in it. And then if you take stock in the buyer, which again probably is taxable when you receive it, you're going to be party to their shareholder agreement also, which has non-compete, non-solicitation. So there are tax benefits, tax issues with assigning value to those, and of course legal aspects to that as far as enforceability and the degree of restriction that the buyer is ultimately able to place on the seller over what period of time. And so, the next bullet obviously is the personal goodwill. That's what a buyer is trying to capture. They need to make sure that the key employees cannot go down the street and start their company back up after they sell the buyer this one, right? And so, again, that's valuable. So non-compete, non-solicitation, personal goodwill, all of those things can have value assigned to them inside the asset deal structure. Now, we mentioned at the very beginning, and we'll go into this a little more, there are many times where we'll find unrecorded liabilities on the books of a seller. Not that they're doing anything improper and purposefully improper, but all of these things have a reconciliation, have an impact on the way that the taxes are treated and the amount of tax that would be due when the transaction is closed. And specifically, as we say, accrued paid time off, the associated taxes with that accrued paid time off. And of course, the big thing, because as most of you talking about S corporations and pass-through entities, probably cash basis taxpayers for the most part, there is a deferred tax liability that we're going to have to discuss at the end of this webinar here before we're done. But before we get there though, I do want to have one more polling question. We need to give you 3 for your credits, for your learning credits. So this polling question talks directly about your attitude towards taxes and how you've handled that liability in the past. So what is your current attitude towards taxes? These 4 questions, Kaylee, if you want to run through them, please. We need 85%, I think, to move on. So Once we open this poll, please jump in here with your attitude about this subject. Yeah, I'm not going to debate how evil taxes are or not. maybe that's a little bit of attitude built into my question there, but the avoidance word is probably much more important than the evil word in that first bullet.
All right, so we're already at 70% here. Go ahead, Mindy. We have a few more moments here.
I was going to say, Brad, you can always, put the other side, and that is taxes are an investment.
Yes.
So that would tell us a lot about our participants.
Yep, exactly.
All righty, so we're at 80%, so we need a few more people to participate in our poll in order to move on here. All righty. So the time that we needed to stay on this poll has elapsed, so I'm going to go ahead and close and share the results for everybody to see. And it looks like 52% is our winner here. They say they manage their tax liability, but not at the expense of the business. And the runner-up is taxes are simply a cost of doing business. 15% say taxes are evil and to be avoided whenever possible. And 9% say they defer all tax management to their accountant.
Well, 52% of you, bravo on the answer. That's, if I had to say right answer, that's the one. Obviously, the government gives our industry, oops, I jumped forward real fast here, but that's okay. We'll stay here for just a second. The government gives our industry a big opportunity to not have to pay taxes on our accounts receivable. Accounts receivable is generally our biggest asset, but many times the difference between that accrual basis profit and your cash basis taxable income can become a problem. So Mindy's going to take us through a couple of sample deal structures here, and then we will get on to that unrecorded cash basis deferred tax.
Okay. So again, even though we've mentioned private equity and some of the things that can be accomplished in that kind of deal, I wanted to more focus on the strategic mergers that we see in our industry, one large firm, purchasing a smaller firm, et cetera. But I wanted to describe the taxability of each of the pieces of consideration. And consideration is just a fancy way of saying, like, how much are you buying my firm for? You'll hear like a purchase price of 25 million, or they'll say the enterprise value is 25 million. That's what that terminology means. So in this first example here, $25 million purchase price, the consideration consists of 13.5 million cash at close, right? So that is taxable at close. It doesn't mean that any amounts will be withheld. I'm just talking about like that is taxable. Part of the purchase price consideration is $5 million in a note. Now the note is eligible for installment sale treatment. So as you receive your note payments over the next, let's say 5 years, right? So your gross profit percentage is applied to each of those note payments. A little bit is interest. And so the interest and then the gross profit percentage of each note payment will be taxable in the year in which it was received. Now, here's where we see a lot of misunderstanding in the industry. And this is part of the consideration is in the buyer's stock. In other words, you seller, I still want to keep you. And I want to keep you as an employee, but I also want to keep you with skin in the game, but I also want you to have a piece of this firm. And so we're going to offer you stock as consideration. Now, this is not rollover. This is not rollover. And there's a lot of misunderstanding there. But in the eyes of the IRS, you received cash and you reinvested that cash into the equity of your buyer. So that piece is taxable in the year that it happened, in the year of the transaction. Now, so that is a very, very typical, I mean, not necessarily the percentages, but that is a very typical deal that we would see: cash, note, and stock. Well, here in this second example, $14 million purchase price. So again, the amount of cash at close, $7 million taxable at closing. Now we pull out $1.5 million in indemnification escrows. So withheld from cash at closing are sometimes multiple, but in this situation, only one escrow, well, two escrows. This $1.5 million escrow. You are a cash basis taxpayer. You did not receive cash. So just like installment sale treatment, right? You are taxed on this when it is released, in the year it's released. The same thing with this next one, the purchase price adjustment escrow. This is just our sometimes 90, 120 days later. We do our net working capital true up, the purchase price true up, but there is some escrow money just in case. So again, you as the buyer, you as the seller, it is taxable to you when the escrow is released. And then now this structure of the earnout is truly a purchase price adjustment. And so it is taxable as installment sale treatment when earned and received. So I went through that fast.
Well, this is real world, right? I mean, this is the way deals look in many cases. And of course, there's no one tax strategy to manage it all. This has to be looked at in its each individual category. So, you know, we're getting lots of calls from people who think they have to sell their firm before December 31st, 21 because tax rates are going up in 22. You're never going to receive all the value in 21 anyway, right? I mean, taxable when released, taxable when received, taxable when earned, all of those things push the taxable income of the deal out into the future. So again, we've not seen a 100% cash on the barrelhead at the time of closing deal, and we've done virtually hundreds at this point in our career. So let's talk, as I said, just for a second about these unrecorded cash basis deferred taxes. You know, simply the tax on the items that the firm is selling that not yet reported on the tax return, right?
So you don't.
But it's that simple. You didn't report it yet because it hasn't been converted to cash, and now you're going to have to because you're receiving cash in exchange for those, right? And so when are they due? Well, so Mindy, maybe you can talk about what coming due immediately, whether the buyer can assume this liability, how are deferred taxes typically handled?
Okay, so this is kind of my, you know, they're due the year the firm sells or goes out of business. That's kind of my tongue-in-cheek way of explaining it to owners. Like, the liability is there. You'll pay the liability the year you sell, or you'll pay the liability the year you go out of business, which, you know, could look really bad. And what I find is that owners will say, no, this is a stock sale and they're buying the company, and, you know, this is their deferred tax liability. Of course, the buyer is going to say, I'm paying you a multiple of EBITDA, which is accrual. I'm paying you, you know, net working capital multiple that is an accrual number, and I'm just not going to, you know, assume a liability for which I've never received a benefit. I'm not going to buy you for it and pay taxes on it. There is you can negotiate at the beginning of the deal, possibly an allowance for deferred taxes. Not usually. I've only seen one. And then there's a very small set of circumstances that has to do with cash basis and gross revenue. And, you know, there's one other little sliver that I've seen before, but pretty much you can say the deferred tax liability is that of the seller. It's handled, like you see here, if it's a C Corp, you're most likely going to have a tax escrow at closing, and then that amount is paid with the final C Corp tax return. S corps and partnerships, of course, you would never record a deferred tax liability on your books because you are a pass-through entity, and it is a liability technically of the owners and not the entity itself. And so that is usually paid by the shareholders on the return in which they are reporting the sale. And this one thing that we've seen is a post-closing balance sheet adjustment or net working capital adjustment for this deferred tax number, where the buyer comes back later and adjusts the purchase price. So to our next slide, know what your deferred tax is. Even if you are a pass-through entity, have your CPA calculate, like, what is my number every year? I kind of need to know. I'm glad that I'm not having to pay this number every year, but what is it? And so one other tax pitfall, I see we're running out of time, that we're running into is if you are a partnership, then you know last year your CPA spent quite a bit of extra time with you reconciling your tax capital accounts and your book capital accounts per new IRS requirement. Well, guess what's coming this year for S Corps? So reporting basis for e-file was already required. It has been for several years. Now they've come up with a new form they want for us, where S Corp basis reporting is required, and you need to know it if you're going to sell your S Corp anyway. So there's your plug for your CPA. Make sure they are calculating your basis. Go ahead and pay for them to do it now.
Well, one more polling question in order to get the PDHs here.
Yes.
How are you doing on this level? Poll is now open. Are any of the following not recorded on your firm's balance sheet? And do you have any tripping points, let's call it, should you decide to sell the firm?
And since we didn't really talk about it very much, I would also encourage everyone, get your paid time off liability on your balance sheet.
Yep. Because
it is a liability of the company, and a buyer is going to look at your financials and do it anyway.
Yeah, absolutely. Absolutely.
Kaylee, are you here?
Yep, I'm here. We have about 53% have voted. I'll leave it open for another 5 to 10 seconds, and then I'll go ahead and close the poll so we can move on. I know we have about 1 or 2 slides left before we close the webinar this afternoon. So I'm going to go ahead and close and share the results with everybody. And it looks like deferred tax liability wins with that 36%. 26% say more than one are missing. Tied at 16% are both PTO expense accrual and allowance for doubtful accounts, or AR reserve. And 6% say work in process.
Okay. Well, it looks like if those of you that are here with a seller orientation, there might be a little work to do. Now, I said we might be able to get a chance to talk to private equity. I'm going to speed past this. There's 5 different things we can talk about, but contact us, me or Mindy, if you are private equity thinking of getting into the AE industry, or if you've been approached as a firm that's potentially going to sell to private equity. There are some very unique concerns that we should get back to. So again, being prepared, remember, tax is generally a zero-sum game. There must be a win-win-win, okay? 338H10 can be the best of all worlds because, again, you can gross up the purchase price, get deductibility. That's a great answer. But again, the tax code is created to make sure Uncle Sam gets their part no matter what. Understand the impact of what you have already done in your firm as far as the structure, as far as the way you've operated, and the way in which you're negotiating the deal. And then understand that tax analysis is an iterative process. Know the difference in the deal for ROI based on different treatments of tax, And again, if you're the seller, it's the after-tax cash formula. The buyer, your ROI will change depending on how you structure the deal and over what period of time those payments are made. Okay. So with that, I'm going to throw it out to questions. We're right at 3 o'clock, finished straight up. But if you have any questions, Mindy or I or both of us will get back to you directly with anything that you'd like to talk about in more detail relative to M&A and tax.
You want to put our email addresses up there?
Yep. There's Mindy.
Oh,
There's mine. Actually, you could probably go back to that original slide, but bwilson@stanbaughness or mtool@stanbaughness. One or both of us will get right back to you. So really appreciate your time and attention. It looked like most people stayed engaged throughout the entire program. So Mindy and I were successful in making a tax-focused webinar interesting, which is no easy task. Nothing against those of you who do tax every day. But again, we hope that you got something that you can take back to your next deal and use to make your M&A process go better.
thank you.
Thanks, everyone.